The stage one is here the credit risk of the issuer. Remember, he explained what is the issuer. Like I told you that issuer is like the borrower. Okay, you issue the bond, then you receive money. That money is not yours. You're like a borrower. You receive money from the public. That money is not yours. You have to pay it back. So that's why we are saying that issuer is like a borrower. So here, the credit risk of the issuer is still low. Okay. For example, the borrower's business. For example, here in this situation, the borrower's business might be still performing well. So in this case, as you recognize here the impairment, losses are computed at the present value of 12 months. Expected credit loss. So as you look for the impairment losses, you just look at what at 12 months. The whole year. So and as well, if you're looking at stage one, it means that as the holder, you the person recognizing the financial asset in your records, you the holder of the financial asset. You must recognize the interest income. The interest income using the gross amount of the financial asset, As you recognize your financial asset in your books, you must base on the what? You must base on the gross amount. This is what you can write about stage one. Basically, you need to know that with stage one, the person is still okay. The borrower is still okay. You have no much doubt that this person will default. Stage two, here there is a significant increase in the credit risk of the borrower, or what we call the issuer. In an exam, we have to use one word. You just put issuer. Okay. So it means that here, I mean that the percentage of defaulting has increased here. So in this case, what you do? In this case, what you do? You are going to rely on the. What? Let me just write something here. Here the entity. Or the impairment loss. The impairment loss is computed or recognized. The impairment loss is computed using the lifetime expected credit losses. In short, when you're at stage one, yeah, you recognize the impairment basing on the 12 months period. But on stage two, as you recognize your impairment, you recognize or you base on the useful lifetime of the what of the loan. Okay. You don't look at 1 year or 12 months. That's where the difference is. Then the interest income must be you, the holder. You must compute the interest income using must be computed using still the gross value of the financial asset, still the same. Still the same. The gross value is like the amount borrowed that I said. So that is stage two. Then stage three, the last one, stage three. Here there is objective evidence. There is objective evidence of credit impairment. Idea that at this point, the customer, for example, here, the customer has actually defaulted. The customer has actually defaulted. The borrower, here we are talking about the borrower or the issuer has actually defaulted. You don't expect the person to pay. So what happens here is that as you recognize still here, the impairment loss is going to be like this. Okay. But the difference is here. As for you, the holder, as you recognize the interest income, this interest income must be computed using the net carrying value, not the gross. You must use the net carrying amount of value, of the financial asset. And how do you get this? Now it's like here, as you get your interest income, it will be the gross amount. Here you get the gross amount. You get the gross amount. The gross amount. Then you subtract the impairment loss. Then multiply by the interest rate. Here you see that as you determine the interest income, you're simply basing on the gross amount. You're simply basing on the gross amount. But for this stage number 3, you get that gross amount, then you remove the impairment. You remove the impairment. Okay. So regardless of the stage, you always recognize the impairment losses in your profit or loss account as expenses. If you have impairment loss on stage 2, you recognize it in your PL. Okay. So that is theory. But you try to read more. You know, this standard is also one of the core standards, especially if you're in a financial institution like banks. This standard is very, 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 very core. So what could be indicators of impairment? Impairment of financial asset. What could be indicators? I want to hear from you. What can be indicators of impairment of financial assets? One. It's a significant illustration where you have the significant financial difficulty of the issuer. You find that the borrower is going through it. Like now, the person had the salary loan. Salary loan, you find the borrower. Maybe the contract was terminated. In that situation, the issue can be very worse. So in a situation where there is a financial difficulty to the side of the borrower, then you have to predict that this person might not pay back. You realize that maybe the contract was terminated or has just left the work. Then also when in a situation where there is a breach of the contract, you're supposed to be paying some money let's say after every like 3 months or 1 month, you pay some money, but you realize that along the way you're not paying. 3 months have elapsed, but you're not paying. In that situation, it can be an indicator that highly likely you're not going to receive your money as a holder. So it can be an indicator also here that your financial asset impaired. Then in a situation where there is maybe talk about death, talk about bankruptcy of the issuer. Here, of course, you don't expect. You may have the security or what, but of course, it is also one of the indicator. Purchase of financial assets. Purchase of financial assets at a deep discounts. It's also something which is not good. That is like the face value. For example, in a situation where you have face or the face value of the let's say of the bond was at 2,000, then you realize that now the purchase price is or the selling price, call it, depending on who is buying and who is selling. And I assume that here it is 1,000. You realize that now. Really the discount from 2,000 to 1,000 is too much. And in this kind of situation, it means that also it can be an indicator. Here you can call it the selling price, depending on who. Here you can the selling price or the purchase price. So in case you find that the purchase of the financial assets are at a deep or deep discounts, then also it can be an indicator of impairment. What are other points? You may be having other points, you list them.
Restructure.
Pardon?
Restructure of a loan.
Restructuring, eh?
Yeah.
Okay, structure the loan, structuring the loan agreement, no? The loan agreement, okay. What else? For example, in a situation where there is no market, disappearance of the active market for the financial asset, it can also be something, especially for those assets held for trading and sale. And along the way, you find that you cannot get the market disappearance of an active market for the financial assets. I think these are enough, but you can add more. You can add more. Here, restructuring, you try to negotiate on the interest rate, like to reduce on your interest rate, like in that kind of setup. Okay, so from this category, please you read more. You read more if you have the textbook or if you have your handout, depending on where you're studying from, or the module you're using. But this theory can also be asked. Now let's switch to our calculation. Okay, and question 3, practice question 3. Required part, they are telling us we advise KK Limited on the relevant accounting treatment of the above instrument in its financial statements for the year ended 31st December 2023. The reporting date matters a lot. The reporting date matters a lot. So they are telling us that KK Limited a 4-year bond from the Lifetime, okay, on 1st January 2021. Also, it is very key, at a cost of shillings 2.5 billion, with an annual coupon of 8%, and effective rate of 12% receivable in arrears. Sometimes it can be receivable in advance. So it's also something you must know. On that, before we proceed, remember yesterday I said that you must know, as you handle these questions, you must ask yourself, are you in the books of the issuer or the holder? Okay, and if you're in the books of the holder, what are you recognizing? The holder is like the lender, the one who is going to purchase the bond. That one will recognize the financial asset. Then the one who giving that bond, you give the bond and receive money. You give the bond and receive money. That money you receive is not yours. So in the books of that person who has issued the bond, must recognize the financial liability. So it's something you must know. Know you are in the books of who. It's something which is very, very key. On 31st December 2021, it was realized that the bond issuer, that is on 31st December 2021, it was realized that the bond issuer has started experiencing financial difficulties. This is one of the indicators of what? Impairment. The issuer, the borrower, has started experiencing the financial difficulties, and there were doubts regarding full payment of the bond cash flows. Okay, an impairment test was immediately conducted and revealed that KK Limited would only recover 90% of the remaining bond cash flows. At this point, for impairment, you must test for impairment. Okay, you must test for impairment. As you test for impairment, you're simply comparing the present value, you're simply comparing the carrying value with the recoverable amount. So we'll see how do you get the recoverable amount, how do you get the carrying value. But at that point, you must compare the two, the carrying value of the financial asset and the recoverable amount. Okay. So KK Limited is seeking advice on the accounting. Okay. Okay. So how do you start? How do you start? So this is the practice question 3. So here we are going to just say this transaction should be accounted for using, okay, this transaction must be accounted for in accordance with IFRS 9. That is financial instruments. Okay. Okay. Then what should we do? And we can say that initially, just summarize, initially this company KK Limited should recognize a purchase of bond as a financial asset at its fair value or the cost, at its fair value of shillings 2.5 billion. Okay, in the what? In the statement of in its statement of financial position as 0. Okay, so you just here you debit what? You debit. Remember, this is an asset, so you debit a financial asset of 2.5 billion. Then you credit what? remember, here this is a financial asset. Remember, for you to purchase this bond, you had to give out money. So you credit your bank or cash. Okay. Or 2.5 billion. Okay. If there is transaction cost, if there is a transaction cost, please you add that transaction cost to this value. Okay. That is as long as you're holding this for to receive the contractual cash flows at the end of the maturity period. Or if you're using the fair value method, like fair value through profit or loss or fair value through OCI. Okay, which we talked about those things yesterday. Then subsequently, we said what? Subsequently, the financial asset. This is your bond. Your bond must be or should be amortized. Over its duration of how many years? Duration of 4 years, as below. Okay, as below. Now, as you amortize, as you prepare your amortization schedule, colleagues, as you prepare your amortization schedule, keep in mind the time when this asset, keep in mind the time when you're going to test for impairment. It's very, very key. You don't need to waste time doing all the years. Remember, here we are supposed to amortize for 4 years, but you don't wait for 4 years. Don't wait for 4 years. For you, what you simply do, put here your years, or your period, then put here the balance brought down, or the amortized cost at the start of the year. Then put here you're dealing with a financial asset. So you put here the effective interest income. The effective interest income. So if you're dealing with the financial liability, you put here interest cost. So then you put here the coupon or the cash flows, the cash inflow here, the cash flow. But even if you put the word coupon, it is okay. Then here you put the amortized cost or the balance carried down, the amortized cost at the end of the year. Okay. So you draw that table, because here it's receivable in arrears, not in advance. This is received in arrears. The first year is which year? Purchased this bond on which year? 1st January 2021. So I can put here 2021. You purchased this at the. Can we keep our figures in millions, shillings in millions? So here I'm going to say 2,500, because this was 2.5 billion. Here you put the actual amount you paid. The actual amount you paid It can be the nominal value minus the discount, then plus the transaction cost. The professional fees, legal fees, mention them. Those costs, the amount you incur to purchase, the cost directly related to this kind of purchase. Here you put you base on the actual amount. Then as you get the interest, what is the effective interest rate? Here we use the effective interest rate, or the yield to maturity, rate, the 12%. Oh, yeah, the 12%, the yield, or they can give you the yield to maturity. That's what you use. Okay. Then here with cash flow, as you get the cash flows, colleagues, it's a must that as you get the cash flows, this one must be based on the par value. You don't adjust here. It's the par value. What is the par value? What is the nominal value of this bond? Don't remove discount. Don't add transaction cost. It's a par value as we get the coupon. Okay. So the coupon rate is what? Is it 6%? From our question, it's 8%. 8%. 8%. It's 8%. Okay. So how do you get the interest income? You simply get the rate times the balance brought down. Then how do you get the coupon? You can get the coupon here, but as you get the coupon is simply coupon. You can do also the working down or somewhere, or at the start the coupon or the cash flow is 8%. 8% times the par value, the par value of the bond. Okay, which is equal to 8% times. Here, good thing is that the par value is the same as the actual value, but in some questions you'll find that the par value is different from the actual cost. The actual cost here, what you put, I repeat, you look at the nominal value or the par value minus the discount, then plus the transaction costs. You only add transaction cost if you're using the amortized cost. You're holding this financial asset to receive the interest and the principal at the end of the maturity period. But if if you can sell this asset at any time, then there you cannot use the amortized cost. If you're holding the asset just for trading, then also you cannot use amortized cost. We talked about those things yesterday. Okay. Here, how much do you get? And where you cannot, if you're using, in a situation where you're not using amortized cost, you don't add the transaction cost. The transaction cost will be immediately expensed. Here you're adding, it's like you're capitalizing those transaction costs. Someone had a question? Someone had a question? Oh, yes.
No, I was just telling you the answer.
Okay. So here the answer is how much?
It's 200.
It's shillings 200 million. Okay. So it will be the 8% times. Let me just put it in the formula. 8% times 250. So this one will remain the same because this is per annum. This one will remain the same up to the maturity period. But at the maturity period, I said that you get the interest, rather the cash flow, then plus the principal, plus here at the maturity period. If this is 2022, 2023, then 2024, because you purchased a 4-year bond. So here it will be also 200, but at the end here, if at all you are doing the financials for 2024, here you get the 200, your 200, then you add the redemption value, which is 2,500. That is if you're dealing with this here. But you see, for us, we don't want to waste time doing everything. We are testing for impairment at the end of 2021. I don't need to waste time in an exam doing all this thing. I just look at only 1 year, then I test for impairment. Okay, so how do you get balance carried down? You simply get the balance brought down plus this. Okay, put these figures in bracket. Put these figures in a bracket, so that you don't then you remove also this you have understood. So you get this plus this, then minus the 200. Okay, so we test for impairment. We test for impairment. We test for impairment. Since it happened on the 31st December 2021, we test for the impairment. We test for the impairment. I can write and say at 31st December 2021, okay, the financial asset, that is your bond should be tested for impairment. Should be tested for impairment. Because why? Because there is evidence of a significant increase in the credit risk of the issuer. Hence, the issuer may default to payment. Okay. Therefore, since you realize that there is a risk of default on payment, then you are going to say that therefore the remaining cash flows, expected from the financial asset, okay, must be discounted using the effective. You discount using the effective interest rate, not the coupon rate, the yield to maturity, or the cost of capital. It's what you use. So here you discount using the effective interest rate. Okay, as below. So you must first determine the expected cash flows. What is our expected cash flows? What is our expected cash flows? And our expected cash flows, is equal to, basing on what do you expect? What do you expect? Let me see from the question. You can only recover how much? You can only recover 90% of the remaining bond cash flows. That's what you can. That's what you can recover. Here, in some question, they can say that, like this one here, they are telling you that accordingly, the 15% probability of default was established on all remaining contractual cash flows. Now here they can give you the percentage of default. Here they have given you the percentage of the percentage of the remaining bond cash flows. So if they give you this, the expected one, you use this. But if they give you the percentage of the probability of default, then for you ask yourself, if this is the probability of default, then what is the probability? What is the percentage, or how much do you expect to recover? The percentage you expect to recover, it will be 100 minus 15. So here they have given you what you can actually recover, which is 90. Okay. So here you can recover 90% of the cash flows. Remember here 90%, the 90% of the cash flows, the contractual cash flows here. It's your cash flows, you're receiving 200 now, 200 per month, per year. 200, sorry, 90%, 90% of 90% only. Now here, the 90% colleagues here, it's coupon plus what? It's coupon and the principal. This is what you can recover. The coupon remaining, or the interest the cash inflow remaining to receive, then plus your principal money. Okay. So the coupon here is the coupon, or the cash flow. The coupon is 90% times every year you'll be receiving 200 million. Depending on what we have calculated here. Every year you're receiving 200 million. So here, what do you get? This is shillings. How much? 180? Is it 180? Shillings 180 million. This is per. You expect this for how long? Remember, you have already received this money, this one for 2021. So the remaining money, the remaining cash flow you expect is for only how many years? For 2022, 2023, 2020, 2024. So it is for the remaining one is for year 2, year 3. Or it is from year 2 to year 4. Year 2 to year 4. That is what you expect to year 4. Okay. Then the principal you expect still 90%. 90% of the principal. What was your principal? The nominal value or the par value? 2,500 million. So here you get how much? Get 90% times 90% times 2,500. 2,500. I have 2,250 million. Okay, and you expect to receive this when? You expect to receive this on the last on the maturity period, that is That is year 4. That is year 4. So you prepare or you look for the, remember here we said that the remaining cash flows expected from the financial asset must be discounted. So you discount these cash flows to get the present value. Okay? And that present value you're getting is actually your recoverable amount. The amount of money you can actually recover. That's what we are trying to get. So here you put your years or your periods, then you put your expected, or some people put here details, first put here details, then put here the expected cash flows, then you put the discount factor, but here you add
We can't hear you. You're breaking.
Sorry about my network. Can you hear me now?
Yes.
Okay. So let's get our present values. Okay. So here you are going to discount your coupon. You're also going to discount the principal. You expect this cash value of 1. Year 2 will be like your year 1. So you will be looking at from year 1 to year 3. From year 1 to 3, because here you expect cash flows for only the remaining cash flow is for only 3 years. So you don't say that now what am I going to use? Here don't use 4. Just here I'm putting it to know that you expect to receive coupon for year 2, year 3, and year 4. So those are only 3 years you must indicate. Okay. Here you put the remaining years only. Then the cash flows you expect to receive 180, and that is the money. Then here you expect to receive 250. That is your final year. Don't put year 4. We put only the remaining period. So basing on the remaining period, it's the last year. The last period is The last period is 3. So discount. Tell me the discount amounts. The discount amounts, you know how to use the table. Here you're looking at more than one period, so you use the annuity table, the second table. Here you're looking at only 1 year, you use the first table, the single period table. Okay, so here it's what? Colleagues, you tell me those with the table. Well, you have one here. Those with the table, you check and tell me. You stand where you have 12% and the 3. But you can't hear me.
I can hear you. It is 2.402.
2.40402. Okay, then here.
It is 0.712.
0.712. Okay, then the present value you multiply. Since we are keeping values in million, you multiply. If you add, what do you get? If you add this plus this, the answer you get, this answer is called the expected or the recoverable. To make it clear, the recoverable, this is what you can actually recover, recoverable amount. That's what you need to test for impairment. That's what you need. So at the time of impairment, at the time you tested for impairment, remember you tested the impairment as at this date. So as at 31st December, this is at balance carried down. As at 31st December 2021, what was the carrying value of this asset? The carrying value of this one. Okay. So compare the two and see whether you actually have the impairment. Do you have the impairment? So at the time of testing, the value of the asset was this 2.6 billion. But you can only recover 2.03 billion. So it ideally means that there is an impairment loss. There is an impairment loss. So here the impairment loss, the impairment loss is equal to the carrying value, of the asset, financial asset, then minus the recoverable amount, which is equal to at 2,600 million, then minus 2034 million. What do you get as your impairment? This is the shillings. How much do you get? 2600 minus 204. I have 566 million. So that is the impairment loss. So therefore, for the year, therefore, let me just say, therefore, that 31st December. Remember the question said We look at other 31st December 2020 what? We hope. Oh. Okay. Here we are looking at other 31st. I think here I typed things wrongly. Yeah, it should be other. Remember, like you see this, KK Limited is seeking advice on the accounting treatment of the above bond in its financial statement for the year ended 31st December 2021. Here I'm putting, so here it's 2021 as well. Just that is a typing error. So this is other till 31st December 2021. What should be reported? One, what should be recognized? You recognize the financial, this financial asset should be written down. Should be written down to its recoverable amount. You're not going to record the financial asset at this amount. No. This is what we should have reported. If I told there was no, this is what we could have reported if I told there was no impairment. But because there is impairment, we must record the financial asset at its recoverable amount. So the financial asset should be written down to its recoverable amount. Its recoverable amount of shillings. What you can only recover, that is 2,2034 million. In its in the statement of financial position. Then number two, this company KK Limited should recognize an interest income okay. KK Limited should recognize an interest income of how much? An interest income of how much? An interest income of shillings. An interest income of shillings. You go back to your effective interest income of shillings with 300 million. In what? In the statement of should recognize an interest income of shillings in its statement of financial, in statement of profit or loss. Okay. Then still in the statement of profit or loss, KK Limited should still recognize an impairment loss of shillings what? 566 million. Yeah, as an operating expense, in its profit or loss, in its statement of profit or loss. Okay, account. Then if you to prepare cash flow statement, then Then KK Limited should recognize the an interest income, a cash inflow. Should recognize an interest income of shillings, interest income of shillings. Here you have 200 coupon, where you have coupon 200 million as cash inflow in cash inflow from what? From its from investing activities, from investing activities in its statement of statement of cash flows. So that's what should be done. That's what should be done. And that's all about this question. That's all about this. That's all about this question. That's all about this question. Any question? Any question? Now, as you see, impairment is coming on 31st December, 2021. Assume let's say we are reporting on 31st December. Let me say 2020. Let me say 2020 what? 2022. What can be done? 2022. What can you do? What can you do? You prepare your amortization schedule. You amortize. You prepare your amortization schedule. You prepare your amortization schedule. Then you prepare a new one, right? You put here, like the way we handle this is when there is a remeasurement, when there is remeasurement, maybe in this term, or for example, this term has changed, interest rate has changed. So you have to prepare a new amortization schedule. So you also put here balance carried down, balance brought down. Then you put here effective interest. Then you put here your cash flow. Then you put here the balance, carried down. Then, of course, this one will remain as at 12%. The rate has not changed, but sometimes you find that the change is now in terms of rates. Then here put still this will be 6%. Then the first year, the remaining period now, you start from 2022. You start from 2022, you have 2023, depending on when you're reporting. What do you put here? You put the recoverable amount. Because like here, if at all if at all we are doing this, we are using this amortization schedule. In 2022, you could put this. So you could put this in 2022. But because you cannot recover this amount of money, in 2022, we must put the recoverable amount. We must put the recoverable amount, this one. That's what we base on. That's where the difference is. That's where the difference is. Then you get the 12% times this. Then as you get your cash inflows here, what do you expect? It's no longer what? It's no longer 200 per year. No, for the remaining periods, you expect only what? You expect only 180. You expect only 180. That's what you put here. You expect only 180. That's what you put. Even here, 180. Because it will be 180 for the remaining period. Then the last period, 2024, it is what you expect in the last period, it is 180 plus this. If you're handling the last period, it is 180 plus 250. 250. That's what you expect at the end. If you're preparing the financial statements as at 31st December 2024, this is what could be your interest income, your cash inflow in the statement of cash flows. So colleagues, that's all. Then here you'll find that you're simply getting this plus this, then minus this. Then here you put what you have here. Okay. So for the year 2022, for the year ended 2022, you could recognize this in your income statement as an income. And then you recognize this as the cash inflow in your statement of financial position. Then you recognize this in your balance sheet. You recognize this in your balance sheet. Okay. So colleagues, that's all. That's all. You will use the same knowledge answer this because it's really the same. Just that here there is a discount, and wherever there is a discount affects the what? Affects the actual, affects only the actual. The discount affects what you put here, affects what you put here. So you debit the financial asset, removing the discount. You remove the discount. You didn't pay that. So it affects only this. But that discount does not affect the coupon. Coupon is based on par. Coupon is based on par. So here the coupon you base on this nominal value. But as you get the balance brought down, you get this, then minus the 5% of this. Do we have transaction cost in this question? No, we don't have. So you don't need to add the transaction cost. Okay. They pay the annual coupon. This is one that is going to help you to get the cash flows. Then this one will help you to get the effective interest income. This company intends to hold the bond until the maturity, until redemption. So here, Here you're using amortization cost, not the fair value through OCI or profit or loss. You're holding the asset until the redemption. Okay, so here on this date, you test for impairment using the same steps. And you're reporting on that very date, on the date you're testing for impairment. Okay. I believe you can answer, isn't it? I want to hear from you. Can you answer this now from our practice question 3? Can you clear this? Huh? I want to hear from you. Because if we do everything, now
We shall give it a try.
someone is saying in the group, how are we getting the cash flows of 6% in the reporting period of it's not 6%, it's 8%. I think I made a mistake. This is 8%. Here it's I think for me I made the mistake. Yeah, it's 8% from the question. It's 8%. The value is the 8. So you get that 8. You get that 8%. Automatically you're going to already you'll be having your what you expect. Where is it? Where is it? Where is it? There is somewhere we had that figure. What we expect. What we expect was here. We have that figure already. So it's 180. You don't again subject that figure to the percentage. Okay, you don't again already the 200 is subjected to 8%. So you don't need to again multiply. Okay. You just pick what you have. So colleagues, kindly try, because when we discuss all these things, you will not know your mistake. You try where you meet challenge. You ask in the group or you inbox me. We share ideas. Try. Try. And time yourself as you try. Try it time yourself. Try it time yourself.
Excuse me.
Yes, please.
I have a question. In question 4, when we are determining question 4, when determining the expected cash flow, I mean the coupon and the principal, we don't use 15%. What do we do there?
This is we don't use 15%. This is 15% probability of default. So what if this is the probability of default? What is the probability of recovering the balance?
85%.
85%. So as you determine the expected cash flow, it will be 85%.
Okay,
Someone
thank
who
you.
asked, is it clear?
It's clear.
So as you determine the expected cash flow, it will be 85% as you determine this. The expected cash flows for you will put 85%. Then you look for 85% of your coupon. You will be having the coupon already above. This one, you'll be having the coupon here. You get that 85% times that. Okay. Then what do you expect to recover as principal? It will be 85% times the nominal value. Don't remove the discount. Don't remove the discount. Discount only affects the actual, what you put under balance brought down. Only that. As you determine a coupon, you rely on what? On 1.4 billion. As you determine the coupon. Also, this will be your principal amount, this one. Any other question?
Some break.
Some break, yes. Some break of how many minutes? 5 or 10? That we handle. So as you try practice question 4 in your free time and May 2025 now. I believe now you have the hint. You try those 2 questions so that you can master the standard. Then let's have a break of how many minutes so that we can do a number. The
10.
number of compound instrument, and that will be all. 10, eh? Okay, break of 10. Financial instruments are presented as the financial assets in the statement of financial position. If the entity is the holder of the instrument, and if the entity is issuer or the borrower, then the financial instruments are presented as financial liabilities or equity in the statement of financial position. So when you see this standard called IAS 32, don't be confused. Don't be confused. It just talks about the presentation. Now, we also need to, this standard also guides especially on the compound instruments. Compound instruments. Now, compound instruments, these are hybrid. These are hybrid financial instruments with the components of both debt and equity. For example, like what? Like a convertible debt, convertible bond, convertible debenture, convertible debenture, among others. Convertible term loan, among others. Okay, so these ones are measured at what? Measurement, eh? The measurement criteria is that initially this standard called IAS 32. Now here you're not talking about IFRS 9. You need to differentiate. Here you're not talking about IFRS 9. Here you're talking about IAS 32. So here initially, IAS 32 require such instruments to be split into two. That is financial liability and equity. Because this is because here you're talking about something that is going to be converted into equity after a certain period of time. Okay, so it must be split into two. So how will you know? How will you know that? How will you know? Okay, let me still say initially. Okay, initially, let me also highlight on this. Initially, the debt component, this debt component, the debt component, component is measured at present value of the expected cash flow, discounted using the interest rate on similar debt, but without conversion. So you will always look for, as you discount the expected cash flows, you need to discount using the interest rate on similar debt without conversion. Okay. They will always give you that rate in the question. Then the equity component, initially, the equity component is the difference between total proceeds, and the PV and the PV of the debt and the liability and the financial liability. I think this makes sense. So that's how we are going to be getting the initial measurement for these two. Then subsequently, the financial liability should be amortized over the duration of the instrument using the effective interest rate. Okay. So here you amortize over the duration of the instrument. However, you need also to be it can be the duration of the instrument. Here, this just understand that here you amortize until the redemption period, or the date of conversion, to equity, because you may find you have the conversion date. Okay. Subsequently, the equity component should be maintained at its original. Subsequently, the equity component, your equity component, the equity equity component should be maintained at its original value. So you don't change anything. Yeah? What can change is only the financial liability. Okay. So with that, let's do some now. Let's do some question about this. We have two questions: November 2023 and also March 2022. So let's see, let's do November 2023, question 3, not 1. Those who missed, you can follow. Here we have 80 marks. We have 80 marks. This is what we are going to handle. We have 80 marks. And they are telling us that the company issued 5%, 100,000 convertible debentures at par, value of shillings 1 billion, okay, on 1st January 2022, incurring legal fees of shillings 150 million. The debentures are convertible. These debentures are convertible in 5 years' time. So you have the conversion date here. Okay. Interest rate of a similar debt without conversion, it's 7%. The effective rate of interest is 10.9347%. The company has not accounted for this transaction in its financial statements for the year ended the 31st December 2022. So we have to account for this. But as you account for this, the examiner is saying, as a financial reporting consultant, you write a report to the board. Here you're writing a report advising with suitable computations on the accounting treatment of the above transactions. So this is a report. And you need to know what should be reported in APL's financial statements for the year ended the 31st December 2022 in accordance with the relevant financial standards. When you have not read, you can confuse yourself. Like this one, you can start thinking about IAS 33. Is it IAS 33? APS, EPS, sorry. Earnings per share. If you have not read very well, you can confuse yourself here. But this is not earnings per share. This is not earnings per share. So, how do we start? How do we start? How do we start? Okay, November 2023, question 3. That is not 1. 8 marks. So we can write a summary, the report. This is 2. I just have a highlight. This is from. This is 2. This is to the board. To the board of. To the board. This is to the board. To the board. The board of director. The board of directors of APL. Then from who? From you, as you are assuming the your role is here, they have told you you are working as you are engaged as financial reporting consultant. Okay, then date. What will be our exam date? Eh? What will be our exam date? Do you know? Exams commence on 18th August. 18th August. So, and advanced financial reporting is on the first day. So that is, me say 18th August, but they might add a week. Just that is my assumption. 18th August. 18th August 2025. Okay, that is the exam date. That is our exam date. This is what 18th August 2025. Okay. Then subject I can say the accounting treatment of notes. You are handling how many notes? 1 to 3, but for us our focus is on note 1. So the introduction, depending on your handwriting, some leave like a space, others immediately start. I submit this report in fulfillment. In fulfillment. In fulfillment of my engagement terms as the financial reporting consultant of APA. Okay, the report contains what? The report contains accounting treatment for you list what you have. Note 1, you have the convertible debenture. Note 2, you will see what you have. Then note 3, you see what you have. Okay. The details are provided below. Okay. I start with my note 1. Which is about convertible bond. Convertible bond or debenture. Here it's a debenture. So we can write and say that the convertible debentures are compound instruments. And since they are convertible instruments, it means that the transaction. This means that this implies that this transaction should be accounted for using IAS 32. So IAS 32, that is the presentation of financial instruments. Requires an entity like the APL to measure compound instruments as below. As below. Initially, what should we do? Initially, we have already talked about all those things. Initially, they should do. They should be split. They should be the convertible debentures should be split into two. They should be split into equity and financial liability. Then the financial our financial liability is the present value of expected cash outflows discounted using the interest rate on a similar debt without conversion. Stature? Okay, so and so this means that as you get your financial liability, therefore our financial liability you cannot get the present value of expected cash flows when you don't have cash flows. You need to first get the cash flows. That is your coupon. Your coupon. This coupon is like coupon interest or coupon interest. This is like interest income or interest cost. And since you're dealing with the liability, this is like the cash. This is like the cash outflow. This is like our cash outflow. Okay, if you're dealing with the financial assets, that is cash inflow. Okay, so basing on our question, what is the rate? What is the coupon rate? What is the coupon rate? The rate attached on the bond is 5%. Sorry, the rate attached on the what? On the debenture. So you get the 5%. The 5% in times the par value times the total par value or nominal value, which is equal to 5% times 1 million or 1 billion, okay? Which is equal to what? If you use your calculator, that is shillings 50 million per annum. So that is our expected cash outflow. So since you have the expected cash outflow, get the present value. Get the present value. But of course, remember these cash outflows, you have the coupon and the principal. Don't always forget. Remember, these things must work together. They must move together. You must have the cash outflow as your coupon and the principal. Principal comes at the end of the maturity period, or at the conversion date. So the principal is simply the redemption value. This is like the redemption value. The redemption the redemption value, which is equal to 1,000 million. Okay, so here you discount, you put here your periods, then you put here your cash, your details, then your cash flows. Then the discount factor, you discount using what? Using the interest rate on the similar date without conversion. So the interest rate without conversion is this is at what? At 7% from the question. Then you get the PV. Get the PV. Here. Do very fast. Do this very fast. So here the period 1 to 5, you are paying interest. 1 to 5, you are paying interest of this is 1 to 5. 1 to 5. 1 to 5. The interest, the coupon is 50. 50. Maybe you can say your shillings in what? Your shillings in a million. What is the discount? This is annuity. You're looking at more than one period. More than. So you tell me the annuity. You tell me those with the table. Then here the 5th year there is the redemption, the principal, and the cash. The amount is 1 billion. You tell me the discount factors. Please tell me. Stand where you have 5 on the last table, then read using the column where you have 7%. What do you have?
It's 4.100.
4.100. Then here?
0.713.
0.713. Okay. So you multiply, you get this times this. Okay, then here. So the total, your financial liability is the present value of expected cash outflows. Here you have the cash outflows, so you sum up. And that is it. Okay. Now, once you get the financial liability, we said that initially the equity component is the difference between the difference between the total proceeds and the financial liability. So here I'm going to get the equity component. The equity component will be equal to the total proceeds. Then minus the financial liability. Do we have the total proceeds? Those are your cash. Those are your what you want to convert at the end. That is 1 billion. Then minus expected minus financial liability, which is 918 million. This is a million. Rather, this is 1,000. How much do you get? So here shillings, it will be shillings. This is what, 82? Yeah, 82. So that is your equity. That is your equity component. Now that we have in this question, we have the legal fees. We have the legal fees of 150. What should be done with this legal fees? The transaction cost, that is like now legal fees are deducted from both the financial liability and equity component based on their values. It's like you apportion. So it means that now, if I want to know the the portion related to the financial liability, transaction costs on financial liability will be simply you apportion. You get the value for financial liability. This is 918 million. You divide it by the total, which is 1,000 million. Then time the total transaction cost, which is 150 million. What do you get? This will be, what do you get? 198 divided by 1,000, then times 150. You get 137.7 million. Then what is the transaction costs? Transaction costs on equity. Transaction cost on equity. The transaction cost on equity component. On equity will be, you still also uptime apportion. You also apportion. The equity amount is 82 million divided by the total 1,000 million, then times 150, which is equal to shillings how much? 82 divided by 1,000 times 150, that is 12.3 million. If you add these two, you must get 150. Here you must get 150. So finally, here what will be your net? Your net financial liability will be the liability initially without the transaction cost. That is 918 million, then minus the transaction cost 137.7 million. And how much do you get? That is 78.3 million. Then the net equity component, the net equity component will be 82 million, then minus 12.3 million. Then what do you get? That is 69.7 million. Okay. So what does this one mean? Entries, if you were to pass entries, initial recognition, if you were to pass entries, you debit. Remember now, this is the financial liability, colleagues. Financial liability, it means that as an entity, it is receiving cash. They borrowed it. You look at it as if they borrowed the money. So once you borrow, your cash or bank amount increases. So you debit bank or cash. By what? By how much? By the 1,000 million minus the transaction. Because here, why are we subtracting? Because you're the one to incur the transaction cost. So you're receiving this, but you're incurring this. So that's why we are netting off. So what do you get here? It's 850 million. Then you credit other things. You credit liability, financial liability. The net amount is 780.3 million. Then credit equity component. Equity component is 69.7 million. Okay. That's what you do on initial recognition. That's what we do. Please take note. Okay, then subsequently, the last part on this question, subsequently, as I said, you amortize the financial liability. The financial liability should be amortized. Over the period, that is 5 years, as below. Recall that equity on subsequently equity should remain. So you have no business with what? With equity. Just amortize financial liability, and that will be all. Okay. So let's amortize shillings in our million. We draw our amortization schedule. Put period. Put balance brought down. Put interest. Because you're dealing with a liability now, you put interest expense. Remember, with an asset, we are putting interest income. And here it's cash outflow. This will be cash flows, but in your mind, you know that this is cash outflow. Then balance carried down. The question is, someone had a question in the chat? Okay. So you're preparing this on which date? You're preparing your financial records on 31st December 2022. You issued a bond on 1st January 2022. So it's like 1 year. Here, this is like you're looking at only 1 year. Don't waste time looking at all 5 years. Don't. Don't. Just you look at the time you issued the debenture and the time you're preparing the records or the stating your financials. So yeah, it will be 20 at the end of 2020 what? 2022? Yeah, at the end of 2022. at the end of 2020, at the end of 2022. At the end of 2022, here our balance brought down will be what? This is the financial liability. Initially, you had how much? You had the 780.3. Then the interest here, it's what? Which interest do you put here? You put the interest, the other interest, not the one you used to do what? Not this one. Please, colleagues, as you practice these questions, you need to understand this. Here, as you get the interest cost or expense, you use this rate. You use this rate. This interest rate of similar debt without conversion helps you as you get the initial recognition. Why? You have the equity component here, but here you're looking at only the liability. Then here the rate will be what? The rate will be what? Do we have this? Already we have this. The rate is 5. Here the rate is 5. The remaining the rate with the coupon. Here it's like the coupon. Coupon the rate remaining that one on the liability or on the instrument directly, which is 5. And as you get this, already you'll be having the answer, 50 million. Put it as a minus. Put it as a minus. Then how do you get here? How do you get the amount here? You get this balance brought down times the interest. Then finally get the figure here. This one plus this, then minus this. So since I'm looking at only 1 year, I'm reporting at the end of 2022. I don't need others. I don't need other periods. I just report. So finally for the year ended 31st December 2022, this company APL should recognize the following. One, they should recognize what? An interest expenses of shillings. Interest expenses of shilling, this one, 85.32 million as a finance cost in the profit or loss. By the way, they can ask this even on comparison number. So you take like this one where you have the finance costs in your consolidated statement. So you do this. Then number two, you recognize this one is what? You recognize equity reserve of shillings. Equity reserve, it was 69.7 million. Because this one is not going to change even on subsequent measurement. So you recognize equity reserve of shilling 69.7 million as in the statement of financial position, that is balance sheet. Then you recognize this as a financial liability. You recognize the financial liability of shillings 815.62 million. In the
Excuse me,
statement.
Abel.
Yes, please.
Maybe to take you back, how did you come up with the interest expense rate of 10.935?
In the question, what do we have? Hey, this is what we have. Okay. I had rounded off.
Okay.
But that's what we have.
Okay.
You use the effective interest rate, not the rate of a similar debt without conversion. This 7% helps you to get the financial liability at the start. Okay, then finally, number four, you recognize what? You recognize what? You recognize a cash outflow in the statement of cash flows. Okay, coupon paid. Coupon paid of shillings 50 million as the cash flow towards this is towards not cash flow from, this is towards financing. This is towards financing activities in the statement of cash flows. And that's all. I believe we have exhausted all. That's all with this question. That's all with that part. But time, you need to really be fast. You need to really be fast. And how do we manage time? Like now, when I say you go and try, this. You should time yourself as you try. The problem is that as we do these things, we don't time ourselves. Be there trying to do a number, someone calls you. Be there, you say, at least, Caster, I have understood. I don't want to waste time. I have other things to do. In that process, you fail to manage time during the exam period. So it's good as we try these numbers, we time ourselves. So go and try March 2022, question 3, not 5. It was also still on conversion. Use the same steps. Colleagues, you read the theory about this one. We have talked about this indicators of impairment. You read the theory about hedging accounting. Hedging accounting, types of hedge conditions. You read. Then you read the disclosures, the financial. What should you disclose? What can you tell? You have to tell the users of your financial statements about financial instruments. So this standard IFRS 7 helps us to know the disclosures that we must include in our notes to the financial statements. So, colleagues, that's all about the standard ICING Advanced Financial Reporting Summary, past papers.
Yes.
So you try, these are questions, all these here. All these are questions about financial instruments. So you sit down at least like lunchtime, you are free there. You try to go through call. Even if you read, if you cannot, try you read through. You read through. At least it can give you some insights. Okay.